Welcome back to the channel. Today we're diving into a topic that can literally change the way you think about investing and even accelerate your path to financial freedom. If you've been blindly settling for average stock market returns, it's time to rethink your strategy. We're talking ETFs, growth, dividends, and how to put your money to work smarter, not harder. Now, before we jump in, let me ask you this. If you're 30 years old and have a solid 3 decades until retirement, would you be content making 14% per year when there's a way to push that closer to 19%? It sounds small on the surface, but over time, it becomes enormous. Today, I'm going to break down exactly how you can make that work for you. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with a fund that has quietly turned ordinary investors into millionaires, SCHG, the Schwab US Large Cap Growth ETF. Its mission is simple: own America's fastest growing companies and let them run. We're talking about mega-cap tech giants like Microsoft, Apple, Nvidia, Amazon, and Alphabet. Here's the best part: Schwab charges a ridiculously low 0.04% per year. That's essentially the same as VOO's 0.03%. On a $10,000 investment, the difference is roughly $1 per year. Basically, you're getting full exposure to high-growth companies for next to nothing. Over the last 5 years, SCHG has delivered an impressive 19.2% annual return, compared to VOO's 14.7%. Let's put that in perspective. If you had invested $10,000 in VOO 10 years ago, you'd have around $40,000 today. Solid, right? But that same $10,000 in SCHG would be $59,000. That's $19,000 extra just by picking the right ticker. In 2024 alone, SCHG returned 34.95%. And using the rule of 72, your investment could double every 3.75 years at that 19.2% growth rate. Here's the key takeaway for younger investors. If you're under 45 and have time on your side, growth-focused ETFs like SCHG are the engine that can take you to financial freedom much earlier than traditional approaches. Now, you might be thinking, what about dividends? SCHG doesn't pay much, about 0.39% yield, because growth companies reinvest profits into expansion rather than paying shareholders. And here's something many people misunderstand. When you're young, dividends aren't your friend. You want your money to grow, not trickle in slowly. Capital appreciation is king. You want your stocks to increase in value year after year. Warren Buffett summed it up perfectly. The stock market is a tool to move money from the impatient to the patient. But what about later in life when you need cash to cover living expenses? That's where things like VOO can fall short. VOO pays around 1.1% in dividends, which is not enough to sustain a comfortable retirement on a meaningful sum. If you're planning for income, don't fall for high-yield traps that promise 6%, 8%, or even 10% dividends. Those often come from companies struggling to survive. The smarter choice, SCHD, the Schwab US Dividend Equity ETF. SCHD isn't about chasing flashy yields. It tracks the Dow Jones US Dividend 100 Index, which has a strict requirement. Companies must have paid dividends for at least 10 consecutive years. That means your portfolio holds dependable giants like Coca-Cola, Verizon, Lockheed Martin, and ConocoPhillips. The yield? Between 3.67% and 4.12%, roughly 3 to 4 times higher than the S&P 500. Imagine investing $10,000 and collecting between $367 and $412 annually, every year, on top of stock growth. Over 10 years, even at a more conservative 12.55% annual growth, that $10,000 grows to $32,500, with dividends coming in along the way. Another bonus, tax efficiency. These are qualified dividends, meaning if you hold SCHD in a taxable account, you pay just 15–20% tax, compared to 22 to 37% on your income. That's more money staying in your pocket. Now let's talk about diversification. VOO is great, but it only covers the top 500 US companies. That leaves out thousands of smaller companies that could be the next Apple or Amazon. That's where SCHB, the Schwab US Broad Market ETF, shines. SCHB owns 2,500 companies, spanning large caps, mid caps, and small caps. You're effectively owning the entire US economy in one ticker, and the expense ratio is a mere 0.03%, same as VOO. Over the last 10 years, SCHB returned 15.07% annually, slightly beating VOO at 14.78%. A $10,000 investment in SCHB 10 years ago would be $4,450, compared to $39,300 in VOO, a $1,150 difference with better diversification. SCHB also pays a 1.09% to 1.24% dividend yield with a 5-year dividend growth rate of 3.34%. It's not a growth powerhouse like SCHG, nor a dividend machine like SCHD, but it's the stable core holding that balances risk across your portfolio. Here's where the magic happens. Using these 3 ETFs strategically based on your life stage. Ages 20 to 35, focus on growth 70%, SCHG 20%, SCHB for diversification, 10% SCHD for some exposure to income. Ages 35-50, start balancing. 50% SCHG, 30% SCHB, 20% SCHD. You're growing wealth while beginning to build income. Ages 50-60, shift towards income. 30% SCHG, 30% SCHB, 40% SCHD. You're protecting gains while generating cash flow. Over 60, focus on stability and income. 60% SCHD, 20% SCHB, 20% SCHG to protect against inflation without risking major losses from tech crashes. VOO isn't a bad fund, it's solid. But good enough isn't going to make you rich. A small difference in annual returns compounds massively over decades. The difference between 14% and 19% over 30 years is not just a number. It's the difference between retiring at 65 and retiring at 55. Investing isn't about chasing trends or flashy dividends. It's about strategy, patience, and using the right tools at the right time. By combining growth, income, and broad market ETFs intelligently, you can maximize growth, generate income, and protect your portfolio. So to recap SCHG for growth, let your money multiply early. SCHD for dividends, steady, reliable income in later years. SCHB for broad diversification, own the full market. The key is adapting your allocation based on your age and financial goals. Do this right, and you're not just investing, you're building a financial machine that works for you for decades. Remember, investing isn't a sprint, it's a marathon. The earlier you start with the right strategy, the faster you reach your finish line. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.